Welcome to GEPL Capital Talks on Tuesday, a weekly podcast, bringing to you an interesting talk related to finance every week. Stay tuned. Hello everyone. GEPL Capital brings to you Talks on Tuesday, a weekly podcast, episode number 35. Our today's topic is Tax Saving Aspects, ELSS versus PPF, by Mr. Tushar Patil, Senior Mutual Fund Research Analyst. Over to you.
Dear investors, investment in PPF and ELSS both qualify for tax deduction under Section 80C of Income Tax Act 1961. Public Provident Fund, that is PPF, is most common traditional tax saving options in India. The main reason of PPF's popularity among taxpayers is due to tax-free maturity payment with government guarantee. Equity-linked savings scheme, that is ELSS, has increased in popularity as tax-saving investments in recent years. However, unlike PPF, ELSS is market-linked and subject to market risk. ELSS funds have a lock-in period of 3 years, which is the lowest in category of options under Section 80C. PPF has a 15-year tenure. ELSS funds are essentially diversified equity mutual fund schemes which invest in equity and equity-related securities across sectors and market capitalization segments. An investor can invest in ELSS either in lump sum or through SIP. Though ELSS funds are subject to market risk, historical data shows that equity has been best performing asset class over long investment horizon. Let's compare PPF and ELSS over different parameters and understand advantages and disadvantages of both. If we compare performance of PPF and ELSS over different investment horizons, we come to know that PPF interest rate is 7.1%, which is not very high, especially when you consider the fact that this is a long-term investment scheme. On the other hand, ELSS has the potential to offer double-digit returns to investors. ELSS category average returns over a period of 3, 5, 10 and 15 years are 10.5%, 15.5%, 13.3% and 11.5% CAGR. Thus, ELSS is one of the ideal tax-saving investment options which will help in long-term wealth creation for investors with high risk appetite. Now about tax treatment. PPF investment offers its maturity proceeds are entirely tax-free. ELSS capital gains from total equity up to Rs 1 lakh in a financial year are tax-free. Capital gains in excess of 1 lakh rupees are taxed at 10%. Investors can maximize their tax benefits by harvesting tax-exempt capital gains up to Rs 1 lakh every year after the lock-in period and reinvest in ELSS to get tax saving under Section 80C. About liquidity. Liquidity is an important consideration for many investors. Tax savings does not imply that you keep your money locked in for long periods of time. The minimum tenure of PPF is 15 years, extendable in a blocks of 5 years. And you can withdraw a partial sum from your PPF account after the expiry of 5 years from the end of the year in which the account was opened. PPF allows one withdrawal every year from the 7th financial year. ELSS mutual funds, on the other hand, are the most liquid investments under Section 80C. You can redeem your ELSS units partially or fully after the lock-in period of 3 years is complete. However, it needs to be mentioned here that you do not necessarily have to redeem your ELSS units after the expiry of the lock-in period. You should redeem according to your financial needs and invest in ELSS as per your financial goals. Guys, in this podcast, we have compared ELSS versus PPF on several parameters. Both PPF and ELSS are very tax-friendly investments. Though ELSS investments are subject to market risk, they offer superior wealth creation potential and more liquidity as compared to PPF. For detailed information about recommended ELSS schemes, please visit our website www.geplcapital.com. Thank you.
Thank you, Mr. Tushar Patil, for this interesting insight. Stay tuned for our next Tuesday Talks, where we will be talking to you about what is a top-up medical policy and why take one. Also use the hashtag AskExpert at GEPL Capital on Twitter and get all your questions answered on the stock market. Thank you.